Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Rob Moise. Very nice to have you joining us here for Investor Education Month at TD Direct Investing. We've dedicated the month of October to helping you build the confidence to invest and trade, and we have a good one lined up for you here today. You might feel anxious that you don't know how to invest properly, or that you're going to lose all your money in the next market crash, something like that, but history paints a very clear and inspiring story that investing through the ups and downs of the market can be a powerful way to grow wealth, and it can be much, much simpler than you might think. So we're going to reveal the historical data that backs all of that up in today's conversation. But before we dive into that, I just want to quickly highlight some of the features in our broadcast platform to help you get the most out of your viewing experience. So I'm coming to you right now from the video player. This is something that you can move around, maximize, minimize, change the audio levels, anything you really need to do to improve your viewing experience. This is the place to do it. You can also check out the resources section on the left side of your screen. This is where we have a link to our guest's blog, where you can purchase his book, and where you can follow him on Twitter/X. He's definitely worth a follow, so check him out. As well, we have past episode links that you can check out that relate to this content that we're talking about today. That can also help you get going in your investing journey, so make sure to click on those. Speaking of which, I had mentioned that this is Investor Education Month. We have a ton of upcoming events throughout the rest of the month that you can find in the upcoming events section in the center bottom of your console there. If something catches your eye, just give it a click and you can get taken to the registration page, and we hope to see you in a future episode. But for this episode, the best part, in my opinion, is the Q&A portion. And so if you want to submit a question to our guest speaker, we're going to try to answer as many as we can. It's on the right side of your screen there as a widget. Punch in your question, hit send, and we'll get to as many as we can. But let's turn our attention now to our guest speaker who's waiting in the wings here and the topic at hand. Joining us is Nick Maggiulli. He's the founder of the investing blog of Dollars and Data, one of the most thoughtful investing blogs out there, in my opinion. He's also the author of the book, Just Keep Buying, Proven Ways to Save Money and Build Your Wealth. And, I'm running out of breath here, he's so accomplished, Chief Operating Officer of Ritholtz Wealth Management as well. Nick, you are pretty selective with the podcast requests you take these days, so we really appreciate you taking the time to chat with us.
Of course. Thanks for having me on, Rob. Really appreciate it.
Yeah, and I have to say, you're making me feel a little bit humbled here. We're actually the same age, and here you are with all these accolades and stuff like that. So it's fantastic stuff. One of the things I really like about your blog and your book is that you make investing data and insights really come alive through narrative, and that's not an easy thing to do. So what's the secret sauce? How do you craft a story that can really help these investing nuggets of wisdom stick in the reader's mind?
I think you have to do a lot of reading of like other material. Like I asked Jason Zweig once, who's a Wall Street Journal. He's very probably one of the best investment writers in the world. And I asked him, when I was really young, just starting out, I was like, hey, what would you recommend for a writer like me? And he's like, read a lot and not about investing. And it's really those connections to the non-investment world that make your writing come alive. And if I'm being honest, like Morgan Housel does this better than anyone. I'm pretty good at it, but Morgan's the best at it. And just those stories is what you remember. If you've ever actually looked in like people at how they do these like memory competitions, or they memorize, like a whole deck of cards in like a minute or something, all the way that technique they use is they tell a story. So like, oh, the heart was at, they have like a story they come up with the deck of cards to memorize it. So it's crazy stuff like that. Our brain is built for narrative. So if you tell a good story, you're going to get someone to memorize it far more than that if I start citing every statistic on the US stock market or something like that. So that's kind of how it works. And knowing a lot of stories helps to, pick the good ones and the ones you like that make the points. So.
Well, we've got some fantastic charts that are going to help paint that picture for us here. And speaking of powerful narratives, in your book, you write all about this mantra, just keep buying, to consistently just put money into the market, and over the long term, just let it grow and kind of ignore a lot of the noise around you. You went so far as to say that this mantra changed your life. So can you just take us through that origin story and why you feel this mantra, just keep buying, is something that long-term investors should take to heart?
Yeah, so there was an American YouTuber named Casey Neistat, and he was talking about, how he kind of grew his, his YouTube over time. And he said another YouTuber named Roman Atwood gave him some piece of advice, and it was just keep uploading. The idea was just to keep using the same consistent actions over time and he'd see success. And obviously he did get very big in the United States and as a YouTuber, and he's done very well. But at the same time, when that was happening, I was analyzing all this data on the US stock market, and I was just keep buying. It's easier, it's more memorable, and I think the behavioral component's built in. So for me, that was the big thing that's the reason I kind of came up with it and just wanted to kind of keep using that term going forward. And it's stuck. It sticks with people. It's very easy to follow up with. So.
Mm-hmm. And speaking of, simple, easy, one of the things I really liked about your book was that you make the point that you don't necessarily need to be a brilliant stock picker, the next Peter Lynch or Warren Buffett here, for this to work for you. In fact, you're actually a really big proponent of index funds and broad diversification over picking specific stocks. And can you kind of just explain why that is?
Yeah, so there's the main argument most people make, and I love that this chart's up right now, it's about performance, right? So like most active managers, most funds will not beat the market overall. So the market, in this case, we'll just say the S&P 500 for the United States, you can use another market, doesn't really matter. But most of the time it's like 75 to 80% of funds won't overperform, won't beat the market. Or 75 to 80% of funds will underperform over, a 5-year period, 10-year period. In this case, and looks like 96%, right? So this is a more extreme factor here case here in Canada. But like over the long term, they find this in every market. These are called the SPIVA reports, SPIVA. If you look them up, you can go to their website right now and you'll see like in almost every market over long periods of time, most funds underperform their benchmarks, right? And so that's the performance argument. I think it's a great argument. That's not the argument I like to make. It's true, but it's not the argument I like to make. The argument I like to make is what I would call the existential argument, which is basically like, if let's say you're a stock picker, how do you know if you're any good, right? And I think the issue is that the feedback loops in investing are so long that it takes so long for you to know if you have any skill. So like, for example, if myself and LeBron James went to a basketball court and no one knew who LeBron James was, but you understood basketball, you would know within 3 minutes that he can play basketball better than me, right? He's a better shooter, he's a better everything, right? You could just tell the feedback loop is small. I shoot the basketball, it either goes in or it doesn't, right? But in investing, you and I, Rob, you and I can go into a stock picking contest and I might outperform you just by pure luck, or I could get GameStop right before all, the crazy meme stuff happened, right? There's a host of things that can make me a, quote, better stock picker than you, and it's not necessarily my skill. So by the time you find out if you're skilled, it just takes too long. And then even if you have that skill, will that persist? There's a lot of stock pickers that'll do well in one environment and not another. And I think for me, it's just the mental, just the gymnastics you have to do to like convince yourself, am I a good stock picker? Am I not? I just couldn't live like that. I have to do something in my life where I feel like I'm actually adding value for people. And so for me, like picking my job and all that stuff, I don't play around with my investments like that. I say, let's just own the whole market. That's the performance argument. And then the existential, I don't think about my passive picks at all. I don't identify that with them. If the market goes down 20% over the next month, I'm not going to be panicking, right? But if I picked a stock and it went down 20%, I'd be like, oh, am I right? Am I wrong? There's a host of reasons, but I think the existential argument is the main one there.
Mm-hmm. I always found it really interesting where you look at the all-star managers one year and then the next year, they tend to fall off the map because it's just so difficult to be consistently picking the best stock. So it kind of underscores the point that you're making there. But I can hear a skeptic saying something like, this all sounds too good to be true to me. All I have to do is invest in the broader market and then just stay out of my own way. That can't be right. What would you say to convince somebody that really can be the case?
Well, in their defense, the hard part is when the market crashes, which it's going to crash at different points in time. It's going to get cut in half again. I don't know when, maybe next year, maybe this year, maybe in the next decade, maybe 20 years from now. We don't know. But, if you just look through history, like it's very easy, but it's not, or very simple, but it's not necessarily easy, right? And I think the hard part is that holding through those difficult periods. That's where most of the money's made is like, can you hold through a March 2020? The thing about March 2020, as bad as it was, it just ricocheted so quickly. It went down, and then all this stimulus happened, and then markets shot right back up. So there was not a lot of pain overall. There was a lot of pain, like in the economy and for individuals. But in the stock market, the pain was very short-lived relative to other crashes we've gone through. I think 2022 was far worse in that regard, and the market declined less.
Okay, so we're going to dive all into this historical data. Again, like I mentioned, we have some great charts that really paint the picture why just keep buying can be a mantra for long-term investors to consider that has worked in the past. So before we get into that, though, I want to have a little bit of fun here. We got a little lightning round. I just want to ask you a few short questions, and you're going to share your take on them in as few words as possible. How does that sound?
Okay, yes, I will try and be quick with it, yes.
All right, let's go. First one up. What is your favorite investing book or resource?
Intelligent Asset Allocator by William Bernstein.
What about
Love
your
that.
favorite investing quote of all time?
Favorite investing quote, Jeremy Siegel. Let me see if I get it right. Fear has a greater grasp on human action than does the impressive weight of historical evidence. I'll say it again because it's a little bit longer. Fear has a greater grasp on human action than does the impressive weight of historical evidence. That's it.
We've certainly seen that play out with many retail investors over time, and we're actually going to touch on that a little bit later. But let's keep going here. What's the most surprising or maybe even controversial insight that you've discovered in your investment research over the years?
Yes, how much luck can impact outcomes. For example, if you took someone in the United States who outperformed the market, the S&P 500 from 1960 to 1980 by 5%, so they had 5% alpha, that person did worse than the person who underperformed the market by 5% from 1980 to 2000. So a 5% alpha from 1960 to 1980 on a total return basis was lower than someone who had negative alpha from 1980 to 2000. Now, of course, those are very cherry picked, but that's just so surprising how much beta matters more than alpha in a lot of cases. Like what the market's doing overall matters a lot more than how skilled you might necessarily be.
Mm-hmm. Kind of highlights the need just to control what you can control, basically. All right, so let's keep going here. What's an investing decision that you've made in your own life, despite the data telling you that you might want to do something else?
So I don't really, the data says don't market time ever, and I really don't. But what I like to do is what Cliff Asness called sin a little. So if I'm like, right now things might seem a little frothy, and people are saying that, and we don't really know. So instead of like, I'm not going to sell all my stocks and move to cash, I would never do something like that. But I might say, you know what? If the U.S. is a little overvalued, I'm not going to sell any of my existing U.S. stocks, but maybe my future purchases, maybe I'll just tweak them a little. I'll put a little bit more into international stocks. I'll put it more into treasury bills or whatever it is. It's little tweaks that behaviorally you can get over this without making drastic moves that could actually cause you to lose a lot of wealth.
Mm-hmm. Soft market timing, sort of, I guess, if you will.
Like very baby market timing at best.
Yeah. All right, and last one here for you. What's the best piece of investing advice you've heard in your life?
I love this quote by Peter Lynch. It goes along the lines of more money's been lost in waiting for corrections than in the corrections themselves. And that's something that I obviously have looked through with research and done a lot with that. We're going to talk about, but I just love that piece of advice. It's so good.
Fantastic stuff. All right. Thanks for taking us through the lightning round. That was very succinct. So well done, you. But let's get into the heart of the matter here. Investing through the ups and downs and why it can be such a powerful wealth creator over time, that just keep buying mantra. One of the key tenets of that approach is that you're often just best to invest as much money as you can, as early as you can. And I can see some new investors thinking that sounds kind of risky, especially if they have the sense that the market's a little bit shaky or something like that. But what does the historical data say about just investing as much as you can as early as you can? I think
in general, sorry about that.
There you go.
So in general, you want to invest as early as possible because let's just look at the data. Let's say you're buying, S&P 500, right? You're going to wait 12 months, right? Versus, averaging it over 12 months. So you have $1,200. So you either put $1,200 in now, that's decision choice one. Choice two is you put $100 a month for the next 12 months. On average, the person doing the second option, choice two, $100 a month, they are going to underperform the other person by about 4.5%. So if you're like, you know what, I'm willing to take that on average, that's going to be the haircut I'm probably going to see. Choice one is going to outperform, about 80% of the time, and it's going to outperform by about 4.5%. So if you're like, that 4.5% isn't worth it for me, then I say that's fine. Just average in over time. Take your time to put the money in if you're worried about the risk, right? But that's what you're going into. And the longer you take to average in, that 4.5% just gets larger and larger, right? So after 2 years, it's closer to 9%. After 3 years, right, you can just see over a 5-year time period, it's going to end up being something like, almost 20% difference, which is a lot of money, right? A 20% difference on your capital can be significant. So in terms of when to invest, earlier is always going to be better because on average markets go up. And that's kind of what the data shows. And this has been true, by the way. This is not just true in the U.S. stock market. I've looked at this with gold, with Bitcoin. Like in the book, I talk about this. I have a whole table which shows all this stuff that kind of makes that point.
Mm-hmm. One of the things I always find most interesting is if you look back on the history of the stock market and you think about all the terrible things that have happened, and yet the market is still higher than it was 50 years ago, 100 years ago, what have you. It really kind of underscores that idea that, the best time to start was yesterday, the next best time is today, sort of thing.
Exactly.
So you talked about the difference between averaging in versus like lump sum. Essentially this idea that lump summing, if you can stomach it, is sort of the better move to make from a mathematical standpoint. But you said you don't mind the averaging in approach too. Like, why do you think that is the case, or why do you feel that way?
Well, I think it's really about kind of your risk profile, right? And so if you're worried, if I'm going to put all my money in like right now into 100% stock portfolio, and you're worried about that, then what I would say is you probably shouldn't be buying 100% stocks. Maybe you should be putting it all into an 80-20 portfolio, 80% stock, 20% into bonds or treasury bills, right? Or a 60-40, I don't know. And so I think if you're worried about the risk, my theory is like your portfolio is probably too risky for you, right? And so there's other ways you can go about, fixing that or making it a little bit easier behaviorally. So instead of putting it all in at once, you could do it over time, or maybe you don't do it, let's say, as I said, once a month for 12 months, maybe you put half of it in the first month, and then you just kind of chunk out the other 6 pieces of it or half of it in the next 6 months. I don't know. There's a lot of different ways of looking at it, but those are just some options you have.
Mm-hmm. Well, one of the interesting points that you make in the book is that you actually agree with people who would say, well, if I waited for a market downturn, I could potentially get a better price for my investments. But you also write that it's probably not worthwhile to wait for that to happen. Can you walk us through the thinking there?
Yeah, so I looked at the Dow Jones data, and I said, let's say you just picked any random day and you just looked at a given point in time, right? And you said, okay, what's the chance that I'm going to see this price again, a lower price in the future? And the answer is 95%. So we pick, and this is probably true of the S&P as well, today's S&P price, there's a 95% chance that in the future there's going to be a lower price than today's price, right? And we're basically at all-time highs right now. So it's like there's a very high chance that if you wait, you'll get a deal. But that 5% of the time, this is the lowest you'll ever see it, like ever again, right? Your whole life, or at least through recorded history, right? So that's the counter is like, yes, you could wait and you might get that, but how do you know when it's the lowest? And once it starts happening, how do you know you've hit the bottom, right? You don't. And so if you start thinking, well, I'm gonna get lower and lower, before you know it, it might just scoot back up, and then you've missed your chance. And so that's the difficulty with doing this, is finding those lower prices and then how much lower they're going to be. It's really difficult to do, especially consistently.
Yeah, it kind of gets back to that the best investing advice that you told us just there a while ago, right? It kind of really underscores that point as well. It was amazing. That was an eye-popping stat, the 95% chance or so of that you're going to have some buyer's remorse basically down the line somewhere, but to just kind of quiet the noise inside your head, right? It doesn't make sense to dwell on those things. Control what you can control, right?
Exactly. And the buyer's remorse is short term, right? You're like looking in the next, year, couple years at most. I mean, sometimes it's within a month or two, but most of the time, like that buyer's remorse is not going to be something that you're going to be feeling. It's very unlikely you're going to be feeling that 20 years from now or 30 years from now. So. Mm-hmm.
Yeah, you talked about, too, a really interesting thing in the book there. You were just mentioning asset allocation. And one of the things that really popped out to me was this idea that if you had lump summed into a 60-40 portfolio, which is a more moderate balance, 60 stocks and 40% bonds, you could have outperformed the averaging in of a 100% stock portfolio. How could that be? That seems like such a big difference. What can you take us through the data there?
I think you'd have lower risk too. So that's the other piece of it. It's like what happens when you the issue is the cash drag, right? So if your cash earns something with treasury bills, it's going to be maybe similar, but like the whole idea is you can go into a far less risky portfolio now, right? And because you're fully invested, like you're going to get all the upside, but if you're averaging in, like that cash is not really, especially it depends on the market environment. Right now, you can actually earn something on treasuries, but like I was writing this in a period where like, the cash is paying almost nothing. So it's like you would have really got nothing by having cash. And so it's just thinking about that. And these are the types of just different approaches you can take to kind of get over this like fear of putting this in. And once again, I don't think this decision matters all that much. Like just pick what works for you. That's not the fact that you're even investing, you're already going to be beat like 95% of people, like, because most people don't even think about investing. The fact that you're getting into this level of detail, you're probably, as I said, already in the top 5 or 10% of investors, because most people aren't thinking about this at all. Most people aren't even investing, let alone thinking about their timing decision with the investing. So.
Well, that's something that investors can certainly feel good about here today. If you're joining in, you've already taken probably the hardest step here, which is getting going. I want to circle back on something, this idea that, we don't want to necessarily wait for a market downturn, but I can see some investors maybe worrying about overpaying for a stock or an index or what have you if they lump summed into that. What did the data tell you about valuations and how much they tend to matter to a long-term investor's performance?
I mean, they can matter in the short run. The issue is over longer periods of time. Like it all just like it all evens out in a lot of ways. Now, of course, that doesn't mean that like if you bought in the early 80s, you know, valuations were low and you had an incredible run. If you bought in 1999, valuations were high, and yeah, you had a rough run for the first 10 years, but coming back, it's actually, you know, now it's been over 20 years. Like it's even if you bought in 99, you've probably done decently well, right? Overall, right? And I think the other thing too is, I know people talk about, oh, valuations, capes are so high, higher than average, but like the composition of the U.S. stock market, at least in the U.S., it's changed so much. Like now we have tech companies now which are far more profitable, and it's very fair to say that maybe these companies deserve higher multiples. So on average, the overall multiple of the market should be higher, and we should be paying more for these earnings, right? For the same percentage of earnings, right? So I think that's a counter, which I think is very fair. So like, you know, valuation's not valuation, so to speak, right? So we can be like, oh, well, these are both CAPE, but they're not, because, you know, we used to be all railroads, now we're all, you know, tech companies, and so, or not all, but very heavily tech oriented. So because of that change, because of the compositions changing, it's very possible that the valuations can change. So we can still be fairly valued, even though the number is far higher. So data is not always data in that sense. So you just got to kind of be careful when you're thinking about that.
Mm-hmm. And CAPE, just to clarify for some in our audience there, and I believe we have a definition up on screen, but the cyclically adjusted price to earnings ratio, which kind of tries to smooth out the valuation of a stock over time.
Yeah, this is the valuation metric. When this is high, the stocks are considered you know, highly valued. When it's low, it's considered they're cheap, right? So the expensive is when it's high, cheap when it's low. And right now they're considered expensive. So.
Right. And so one of the things I'm hearing from you then is like valuation is probably more consequential for somebody who has a shorter investing horizon than somebody who has a longer term investing horizon. Is that a fair characterization?
Yeah, I would say that. I mean, valuation, it matters. It matters more on individual stocks. It matters more than anything, because anything can happen with an individual stock. When you buy a basket of stocks, like even the S&P 500, you're not really buying like one snapshot of stocks, because over time, certain stocks are going to get removed, new stocks will get added. So you're kind of always refreshing what you own. And this is just like a natural momentum strategy, so to speak. But, you know, if you're saying, oh, well, yeah, the valuation doesn't matter, oh, this stock's super high, I'll just buy it now. Like if you buy an individual stock, this is not true. This can only be applied to general diversified broad market indices. So just keep that in mind. I'm not saying valuation does not matter for stocks. It does matter, especially for individual stocks. But as you get bigger and bigger in terms of your diversification, it matters less over longer periods of time. That's the exact takeaway.
Okay, great stuff. Let's take a little bit of a pause in the action here for a little bit of fun. We have a trivia question for our audience. The trivia question goes like this. The S&P 500 index recorded an average annual return of about 7.5% between 2001 and 2020. What was the average retail investor's return during that time, according to an analysis done by JP Morgan Asset Management? So you have your choices up there on the screen if you're joining us in our broadcast platform here. If you're joining us in our YouTube live stream, if you check out the description below, you'll actually be able to hop into our broadcast here, and you can actually quickly get your vote in if you want, or you can kind of just sit back and see what others voted on here. But cast your votes now. We're going to reveal the answer in just a moment. Nick, I know you know the answer to this, but perhaps you can offer a subtle hint to our audience as they place their votes.
So I actually don't know the answer to this. I know we had like a doc. I didn't actually see this part, so I don't know the answer. My guess is honestly C. Honestly, right now, I do think it's below the average. I don't want to bias people. I want you to think of your own thing. Think of what you would have said before I said that. I think it's probably below what the market got for a host of reasons we can discuss, but I don't think it's 2.9. That seems too low to me.
Okay, so we'll see if you're right. While people are casting their votes, just a little aside that I thought maybe we could just chat about here quickly. I've sometimes heard some people in the market worry about something like an index fund bubble. What are your thoughts on an index fund bubble? That everybody piling into index funds is going to, skew the market in a way that will hamper returns going forward. What do you think about that idea?
This idea has been debated for so long. You can look up things on the Bogleheads forum, which is like the Vanguard stuff. You can see all this. They've been debating this thing for forever. And I don't think we're at a point yet where this is true where there's massive market manipulations. Of course, there's, you can front run stuff with like the HFTs are front running. Oh, we know this stock's going into the index, so a lot of people are going to buy it so they can make a little bit of money. Like there's stuff like that going on. But, if this is true, then go pick stock. Like then active should be outperforming more than ever, right? That's what we should see, right? If this is all this big inefficient, well, we're idiots buying passive, then all the active managers should start crushing it more. And I haven't seen that yet. And maybe this will happen in the next cycle. And I'll be like, yep, we got too big on passive, and I'll admit defeat. But until then, I think the market, was it this year or last year? I can't remember. We just passed where passive is now. There's more money in passive than active funds just now, after we've been talking about it for forever, and we just finally passed it. So I don't think this is a big concern yet, but I think one day it can be, and we'll see. We'll see that day. I wait to see what happens.
Right. Time will tell eventually here. Okay. Well, so I think we've given our audience enough time to vote. So thank you, everybody who cast their vote. Let's see what the audience thinks the answer is, first off. So I'm seeing here that most people, Nick, maybe you did sway the vote a little bit here. Most people, about 35%, said 4.5, like you did. But the actual answer is 2.9%, if you can believe it. It was that low. The analysis by JP Morgan Asset Management found that your retail investor earned just 2.9% in that time when the market earned 7.5%. And the reason that they attributed to this was the performance gap of basically poor decision making, particularly during times of crisis. So the average investor would often sell their investments during recessions or a market crash after the damage had already been done, and then they essentially crystallize their losses. And then they wait too long to get back into the market and reinvest, and they miss out on so much of the recovery. So I thought this was a really interesting thing to highlight here, and I think it really does underscore that just keep buying approach that you were talking about. What do you think?
No, I think just keep buying is obviously the right solution here, but I'm always skeptical of these because let's just think about, like, when they say average, what does that mean? If someone had a negative 100% return, is that averaged out with a positive? Like, what does that mean, average? Are they taking all the investors over this time period and just finding the median return? Like, I don't know what that number means really, but the example is the worst part, right? Like, they say, okay, the average investor sold during the recession, so they sold after the decline and they bought too late. Who bought it from them? Like, I know they always tell this story, and I'm in wealth management. Like, we tell the story too. Oh, all the retail investors, they sell at the bottom and buy at the top. It's like, well, then who are they selling to and who are they buying from? Like, there has to be some retail investors that are doing it, and they say, oh, it's not retail, it's all institutional. The institutional is all the smart money. I'm like, I don't believe there's like one smart segment and one dumb segment, and they're just like trading money back and forth. I really don't believe that. I do believe some people can time some of the time, but like, institutional investors have lost a ton of money as well, and they are also part of the selling. So I'm very skeptical. I think actually the typical retail investor, some will do something like this, and some will actually get out before a big crash and get lucky and buy back in near the bottom. I do think it happens, right? So I'm very skeptical of these perfect little stories that we tell, because on average, I think it's a little bit more mixed, and I think the data is not as clear cut as they say. So that's kind of why I think that the real answer is probably closer to 4.5 than 2.9. But maybe I'll have to read that study.
Okay. I hope it's not sour grapes here, just that you got the answer wrong, Nick, right? That's not it.
No. I just think, like, you think about that story, it's like, oh, the average, what does that mean? The average investor often sold their investments during recessions. Who bought the investment then? The unaverage investor, like, oh, the smart person? So you're telling me there's more people that can market time? Because there's no data that shows that. Like, and they market time every single time? Like, no, like, it just doesn't make sense. So that's where I'm like, how does the story doesn't make sense? Maybe the data is correct, but the story around why doesn't necessarily make sense. So. All
right, well, we'll leave that digging into that data for another time, but let's continue on with our conversation here, because another major tenet of the just keep buying mantra here is that it's probably not worthwhile to wait to buy the dip, as it's called. And this I found really surprising when I was reading your book, because this is a strategy we often hear investors really enthusiastically endorse. And in theory, it makes a lot of sense, right? Like, I wait till the price falls and then I buy a depressed price, basically, and I get better returns. But what, in your mind, is the problem with buy the dip, that mentality, at least based on what the historical data tells us?
It's just sitting in cash. You're sitting in cash for too long. All that money that could have been earning money is just not, even when you adjust, like, if that cash is in a treasury bill and earning something, it's still, the data shows it just doesn't work out, generally, compared to investing in like a diversified equity portfolio. So that's it. Well, it's once again, it's the Peter Lynch idea, more money's been lost waiting for corrections than the corrections themselves. So.
There was a really funny quote I really enjoyed in your book there. Even God couldn't beat dollar cost averaging. Can you unpack that for us? Because I loved that quote so much.
So I did this thought experiment where I said, okay, you know what? I'm going to have you try and quote buy the dip, but I'm going to tell you exactly when the bottom is. So the only rule, there's only one rule of the game. You have to keep buying. You can hold cash and then make purchases. You can't sell everything and go to cash, but once you make purchases, those are invested, and then you just hold cash to the next dip, right? That's the key. And what I define a dip is the lowest point between two all-time highs, right? So if you started doing this, okay, let's say you're waiting. Okay, you bought like at the first big dip. Okay, you actually got a great purchase. But then if the market keeps going up, okay, it keeps going up, and then finally there's a dip. If that next dip on average is higher than all the other prices you could have bought previously, right? And so the story I tell is like, I remember in 2017 I started writing, and people are like, oh, you know, market's too overvalued. I'm going to wait till there's a dip in 2017, right? And what happened is there wasn't a big, I mean, there was a very small dip at the end of 2018, but it wasn't a major one. And then 2019, there wasn't a dip. The first big dip we had was March 2020. And guess what? If you had bought on the exact bottom, if you could perfectly time it and get the exact bottom in March 23rd, 2020, you would have bought at prices 7% higher than the beginning of 2017. And that is the reason why buying the dip doesn't work. Because even when I give you the perfect dip, I give you the information ahead of time, you perfectly time it, and still on average, you would have paid more than if you had just bought, you know, many years ago and just kept buying over time, right? So that's the big takeaway here, is like, that's why it's just not profitable to do this buy the dip strategy.
Yeah, and it was interesting too, reading that if you were even just a little bit off on that optimal timing of buying the dip, like your returns were just impacted so negatively. So it really goes to show that, you know, we really can't know what the future may bring, and it might not make sense to try to do it. But what about like a middle of the road approach? I can see some investors thinking about, like, you know, I hear what you're saying about, you know, just keep buying, but what about if I keep a little bit of cash on the side and I'm waiting to buy the dip with that? Well, what do you think about that kind of approach?
I think that can make more sense, because I think it's, once again, it's like my sin a little. It's like a behavioral hedge idea. It's like you need to kind of get this out of your system. And so if you're like, okay, I'm going to put 5% of my money on the side and the rest is indexed, right, of your portfolio, I don't see a problem with that. Of course, on average, that's going to be less, you know, on average, it's going to be less, you know, profitable. You're going to have lower returns, but it's such a small portion of your portfolio. If that keeps the other 95% invested, then it's worth it. It's actually completely worth it, right? So that's kind of the way you think about it. Like, hey, I want to have my play money. Go ahead. I think it's actually a great idea, because if it keeps the other 95% invested, you're going to outperform most investors just from that, like, alone, let alone anything else. So
yeah, some people have that itch that they just need to scratch. They need to be picking investments, timing investments. So it's kind of like the core and explore approach, they call it, right? You have your core investments, but then you keep a little bit on the side as your explorer, and you can kind of play money, as you put it. Another one of the core ideas that I wanted to touch on in Just Keep Buying was that long-term investors really shouldn't be fearing the volatility of their investments. You go so far as to call this the price of admission for successful investing. So what do you mean by that?
Well, even in good years, you know, the market will typically drop by 10% from the beginning of the year. So if you bought on like January 1st, like the typical decline from January 1st, even in a year where you're up positive, like you will see from that point, at some point you're down 10%, right? So even in good years, yeah, this is called the intra-year drawdown, how much the market goes down within a year. And, you know, the average here is quite high. And like even the median's like is probably, I think, over 10% as well. But it's like, even in a good year, we're like, oh, actually, we're up, you know, 5% this year, 6%, 10%, whatever it is, you know, you're still going to see drawdowns of some sort, right? And so volatility is just a part of the puzzle. Like we just had this, I can't remember the date, August something, whatever it was, where the Japanese yen carry trade went off, and the you know, VIX shot up to like 80 something, and it's like everyone thought the world was on fire, but it quickly reversed. That's the type of volatility you'll see, where you'll see a quick drawdown and things will be like, whoa, that was actually not necessary, and then things can correct. So that's what most drawdowns are. It's only rare that we have large drawdowns that represent large structural changes or large economic changes that are impacting markets.
Yeah, one of the things I took from your book is that, you know, there is a degree of risk in not taking enough risk. If you're a long-term investor and, you know, you want to, let's say, you have enough money to retire, if you play it too conservatively, you're going to have to make really big contributions to kind of make up the expected performance difference there. So the diversification that you're talking about here through index funds, as an example, can really help you kind of ride out the big drops. that we sometimes see in individual stocks or even indexes as well, and kind of get you over that fear of risk that you're taking. One other thing too, we often hear investors talk a lot about, obviously, is market crashes. You know, they can have a really big impact on your portfolio. And a lot of people are just definitely afraid of having a market crash happen. But for a long-term investor, you actually kind of turn this on its head and you see market crashes as a buying opportunity. So that might sound counterintuitive to a beginner, for example. So why would an investor want to buy stocks when stocks are falling?
So, I mean, I just thought about this mathematically. So once again, this is true. Like, I'm not saying hold cash and wait for these dips, but if you're conditional in a dip and you happen to have cash, right, you shouldn't really. But let's say something happened. Let's say you get paid an annual bonus, hypothetically. We're at some company and you get an annual bonus, right? And you get your bonus paid, and then literally as that's happening, the market is now down like 30%. The math I like to do is, like, if you assume that the market's going to return some percentage a year, it doesn't really matter. Let's just say you pick 5%, right? That's the average return. If you expect that, you know, if the market goes down, you know, let's say 20%, right? To get back to normal, it has to increase by 25%, right? This is just math, right? If something gets cut in half, it has to go up 100%. So a 50% decline, 100% growth needs to come back to get back to even, right? So once you do that, you can then back out, like, what's my expected return from here back to just our old high, right? And so in March 2020, when, you know, we were down, I think 33%, right? So to get back to even, it was a 50%, you know, return upward. And I asked Twitter, I was asking some people, or Twitter X now, but I said, you know, how long do you think it's going to take for the market to come back? You know, is it going to, before we hit a new all-time high? I said 1 year, 2 years, 3 years, more than 3 years, right? All these different questions. And even if you had picked 3 years, right? If you take 50% and you divide by, you know, do the math, you know, it's not exactly don't divide by 3, but, you know, you do the actual compounding, it's something like, you know, 17% a year growth or something, or, you know, 15% a year growth or something like that, right? You get 15, 15, 15, you basically get to 50%, right? So it's like, isn't that a great deal? Even if you think it's going to take 3 years for the market to recover, that's an amazing deal, right? So it's like, once you just do the simple math on it, you're like, yeah, I would take 15% returns. And guess what happened? We had the greatest, like, probably the best 1 year return we might ever see in our lifetimes, right? In that 1 year from March 2020 to March 2021, I think the market was up almost 100%. It was, you know, it's like one of the greatest 1 year returns ever. I think the only two that beat it were in the 1930s, right, from the Great Depression. So all I'm saying is, like, just do the math on it. Like, okay, if we're down 20%, that means we have to get 25% to get back to even. And then how long do I think that's going to take? Even if 5 years, you know, 25%, 5 years, that's roughly like the average, you know, the 5% return roughly. So it's like, okay, is that a bad return? No. So even if it takes 5 years, you'll get a decent return, right? If you think it's only going to take 2 years, now you're looking at, you know, 12% returns for the next 2 years to get back to even. So just do that math in your head and you're like, wow, actually, this is an opportunity. So that's how I like to think about it, you know?
Mm-hmm. Let's play devil's advocate here, though, because what about if we think about something like the S&P 500's lost decade, which was between 2000 and 2010, when it took a long time, like 10 years, to break even after like a big crash. Does that change the calculus at all?
Well, of course. I mean, in that case, yeah, it took much longer. And that's the thing. It's tough to know, right? And so let's look at the lost decade. Okay, 2000 happens. You're down. I don't see the problems. I don't have all the data like on hand to look at this, but it's like, okay, you're down 10%. Would you get in? Like, I don't think that's enough for me to be like, oh my gosh, let's do it, because that happens every year, right? Like 10% is nothing, right? So I only start to get excited after really 30%. People say 20, I say 30% because those are rare. Those only happen only so often. We had 2020 was one, 08 was one. We basically saw, you know, 50% decline from the dot-com bubble. But then before that, you got to go back to 1974, 75. So it's like, these things are rare. You're getting a 30% decline. That is something to like think about. So yeah, if it was coming down, I wouldn't have done it until it was 30% down. And maybe that was until 2002, maybe. I don't know. I need to look at the data again. But you know, and then from 2002, buying back in, that's actually not as bad, right? So that's just something to think about. And once again, these things happen. We have lost decades. We had the 2000s. We had the 70s was a lost decade. We had the 30s, but every other decade has not been a lost decade. So there's just different ways to look at it. And yeah, that's my counter to people that would say that.
Yeah, there was a great study that you referenced in your book as well, and it kind of looked at across 39 countries from something like 1841 to present day, and they saw that the real losses over a 30-year time frame, in other words, if you're a long-term investor, was roughly like 12% or 1 in 8 that you would lose money. And this is across many different markets, not just the United States market. So That's pretty good odds that, things are going to work out in your favor over the long term. I mean, we don't know what the future can bring, but I at least found that pretty heartening to know that the data was that much in your favor.
And now we even have access to diversify across the whole world. And is there a 30-year period where the whole world has not seen growth? I don't know. I don't know if the 1902 to 1932. I mean, they didn't have a world basket of stocks. There weren't even that many companies that were publicly traded. Like, you couldn't even do this thought experiment. But like, maybe that 30-year period would have seen a negative real return, but I doubt it. I even think it would have been positive even over that period into the depths of the Great Depression.
Right. So all of these things that we've been talking about, it really does underscore this idea of, just keep buying. Historically speaking, you would have done pretty well. So keep that mentality, that long-term focus in mind if you're an investor who's at all worried about some of these things. That's the interview portion of our conversation here, Nick, but we're not done yet. We are going to get into the live Q&A part. Like I said, my favorite part of the conversation. We're going to hear what our viewers want to hear more about. If you're joining us on the YouTube live stream and you want to ask a question, you can do that. Just check out the description in the video. You will see a link to hop into here, and you can submit your question in the broadcast platform. But Nick, are you ready to take some questions from our viewers?
Yes, I am. Let's do it.
All righty. Let me just call up my questions here. So we have a question here coming from Eric. And Eric wants to know, if you're fully invested with no additional funds available, dollar cost averaging is not an option without rebalancing in such a scenario. So how would you decide which assets to sell and which to buy?
I guess this is like based on your risk tolerance, right? So if you don't have no more funds to buy like the quote underweight asset, then like, yeah, you have to rebalance to whatever your kind of your target risk tolerance is. So people use the example of a 60-40. If your target 60-40 and you have 70% in stocks and only 30% in let's say fixed income, then you would have to sell some of the stocks and buy more of the bonds to get back to even. So there's obviously different ways of doing this. I think for most people who are accumulators, I would just keep my stocks as is. I don't sell anything and I just buy back bonds. That also prevents tax things. If you have a taxable account, you don't want to be selling stuff and then having to pay taxes. So that's another nice thing about what I call the accumulation rebalance. But you're right. Without the funds, you have to find a target thing you care about. Hey, here's my target, and am I in tolerance or not? And then I make adjustments to get to that target.
Okay, good perspective. We have another one coming to us from Anthony. This is a long one, so bear with me here. But he says he's a 25-year-old investor, and he's currently been putting most of his income into his brokerage platform, in this case, TD Direct Investing. He doesn't have many bills, so it's doable that he's able to put away 60% of his income, which is fantastic, Anthony. I have been buying some individual stocks, mostly tech stocks, and I've got some good returns. But I'm also a long-term investor, so with many big stocks nearing their all-time highs, it's making me scared to keep buying. Are ETFs, a better move than individual stocks? We kind of talked about that. He says he's got some, specific tickers there, but he's basically asking, like, should I not be scared of that and just keep buying more stocks, or are the ETFs the way to go in your mind?
Yeah, so we've already, as we discussed, like, I think the way to go is to diversify and get a diverse basket of stocks. And if I'm being honest, like, if you own like an S&P 500 fund, like if tech starts to go down, like, yeah, your individual stocks are going to be toast, but like the S&P is going to see hits too, because remember, a lot of the S&P is, comes from those tech stocks. So either way, if there's a crash, it's going to be bad either way. I guess it depends on what your goals are and what are you doing. Like, what are you doing with that marginal dollar? You're bringing a dollar home. What are you going to do with it? Do you want to buy a home? Do you want to buy a home in the next 3 years? And it's like, maybe I need to put that into something a little bit safer versus playing the stock market. If you're like, no, this is for my long-term retirement, then yeah, you can just keep buying ETFs and keep a diverse basket. So I think a lot of these questions, it really comes back to what are you trying to do? You're 25 years old. You got to think about your plans, because I didn't really do that as well as I could have. And now I'm much more like on top of like, okay, if I want to buy a home, like I'm buying most of besides my retirement accounts, which are doing the same thing they've always done, all of my purchases outside of my retirement account is mostly treasury bills at this point, because I'm trying to buy a home. And if you're trying to save up cash to buy a home, like, you can't be risking that in the stock market, because the market can go down 20, 30, 50%. And I don't want to see that happen. Right. So I'm just keep buying right now as my treasury bills, because I have a goal. I have a specific goal in mind that I'm going for. So you think about what your goals are, and given you're younger, you probably can keep buying, equities. But yeah, there's risk there. They could go down. So if you're worried about that, maybe buy something that's a little bit safer, just and maybe diversify a little bit so you can sleep at night. That's really the key. Is like, if you're asking the question, it says a lot, right? Just the fact that you're asking it says you're probably worried, which, as you said. So I would think about just diversifying a little, and maybe on top of going into ETFs, think about other things besides stocks and how that can add diversification to your portfolio.
Yeah, Anthony, again, I mean, to put away 60% of your income, you're doing something right. So that's pretty good. Just maybe a follow-up on that, Nick. The idea, we sometimes hear people ask this idea of like, what is short-term? What does short-term versus long-term mean? What is short-term? What is a short-term time horizon in your mind?
3 years is short term. I would say medium, short to medium, start to get to 5 years medium term, and then long term I say is 10 years plus, right? So if you're like, hey, I don't need this money for 10 years, I think you can take the risk with stocks. Yes, are there 10-year periods where they don't perform? Yeah, but guess what? Even if you had bought in 99, by whatever 2013, that took a little bit longer than normal, taking 13 years, but that's the worst, inflation adjusted drawdown in US history, right? So like I'm cherry picking the absolute worst thing you could have done, right? So I think a 10-year time frame is generally okay. Of course, you might lose a little bit on it on real terms, but it's probably worth the risk. If anything under 3 years, you got to be doing treasuries, whatever, just earning some yield, whatever you can get. I think it's too risky to say, oh, you know what, market won't go down, because we saw what happened in COVID, how quickly things moved. It could get far worse than stuff like that within a 3-year time frame.
Okay, thanks for clarifying that for us. Let's move on to a question from Brian. And Brian wants to know, to be clear, are you suggesting investors should focus on broad index funds that are market weighted versus an equal weighted option?
So this is also highly debated, and it's debated because market weighted is basically going to be, I guess it's going to be more like a momentum strategy or a growth strategy. And equal weight is going to be more like a value strategy, right? Equal weight means I put the same amount of money in all the stocks, not based on how big they actually are, right? And so there's some that say you should do equal weight, but basically what equal weight boils down to is like you're upweighting the smaller stocks. It's like a small value bet in some ways. It's not exactly that, but that's closer to what it is. Market weight is like a growth thing. I don't know, like during some periods, equal weighted outperforms, during some period, market weighted outperforms. It's like the last decade, it's mostly been market weighted. That's just what happens. At some point, equal weighted is going to outperform, and they're going to say, yeah, I told you idiots for buying market weighted, right? But it's like, I can make the same argument now about equal weighted. So this is, once again, these are preferences. The same thing with like international versus domestic, how much you have in each. International hasn't done as well as the U.S. domestic stock. So because of that, people are saying, see, I told you guys never to buy international stocks. Well, guess what? One day, I'm telling you, there will be a day when international outperforms. There's going to be a time period where international outperforms U.S. Until then, once it happens, then it'll be the flip. People say, oh, I knew international would come back, and so it's preferences and just we're honestly guessing. It's tough to know the future. That's the difficult part.
Since you bring up international exposure, do you have like a rule of thumb as to how much international exposure kind of generally makes sense?
Yeah, so mine, I try to do it, keep as close to market cap weights as I can. So like right now I'm 50 of my equity piece. I'm 50% US and then basically 50% international. And that includes like developed plus emerging, and there's a mix in there. I think it's probably 50, 25, 25. That's a rough idea. And obviously it changes, it fluctuates over time, but that's kind of where I try to keep it. And it's just something that works for me. And so obviously, like, yeah, does that suck? I've been doing this for, since 2012. I've been doing this for 12 years, and, half of my equity portfolio is not doing as well as the other half. And does that mean, should I sell my internationals? No, I'm keeping them, right? You have to, over the long term, they have performed roughly similarly. Over the last 10 years, they've done terribly, but go look from 2000 to 2009 and go look at how well the U.S. did compared to international, and you'll say, oh, wow, I'd be telling the exact opposite story on this right now if we were talking in like 2010 versus talking in 2024. So who knows? There's debates to be had, but I still believe in international stocks.
Okay, let's keep this train moving here. We got a question from Rahul coming in. Rahul wants to know, do you have any historical data on stock or ETF performance in November, specifically showing patterns or trends based on whether a Democrat or a Republican won the U.S. presidential election? Any difference between, NASDAQ, S&P 500, anything like that? What does the data say about the impact of presidential elections and their outcomes on the markets?
So the data on this, it's like there's so much, like so many people have looked at this question has been asked in so many, maybe not in November in general, but like, oh, do you make more money when Democrats are in office or Republicans or this, that? And my favorite one is like, if you'd only invested when Democrats were in office, you would have made X, right? When you're only invested when Republicans office, you would have made Y. But if you invested when they're both in office, you would have made like 10 times both of them. Like, because sitting in cash during one or the other, you just missed out on so many gains that it just goes to show like it doesn't really matter that much who's in office. Of course, it matters for economic policy, it matters for taxes, it matters for your personal life a lot more. But for the market over the long haul, at least historically, it has not really mattered that much. And of course, you're gonna be like, well, Nick, we had and there's debates to be had about like, okay, well, what caused something? Like, if we just had a Democrat and then the market crashed as soon as a Republican took over, does that mean, is that the Republicans' fault or is that Democrats' fault? There's all these, there's no causal linkages. No one knows. I'm personally very, like, I don't think it matters at all. I don't blame either party. I think it's made up. And so when I hear a question like this, I think these types of things are mostly noise. I don't focus my attention on this. If I'm being frank with you, I don't know anything about your background or history. I would spend my attention focusing on something else, not the short term, what's going to happen, whether a Democrat or a Republican wins the U.S. election. So I would say focus on your income, your skills, all these other things. That's going to have a far bigger impact on your life than what goes on with the president or whatever. So. Mm-hmm.
Okay, fascinating perspective. Thanks for the question, Rahul. Interesting question. Let's keep it going here. We got a question coming in from Pat, and Pat wants to know, would you have the same advice, just keep buying, for someone entering the stock market later in life, let's say they were in their late 50s, and have funds in other sort of diverse areas, he's thinking cash, some mutual funds, bonds, all that stuff?
It's actually funny. So I don't know if this is true in Canada. I would assume it is, but in the United States, the funniest thing is, they looked at like all these retirees and like what do they do like with their portfolios, and most retirees just live off the income that their portfolios throw off, right? So some retirees don't even have a portfolio. They just live off, like in the United States, Social Security. They live off the government pension basically. But for those that have portfolios, most just live off like the dividends basically. They don't even touch the principal. Like only like a very, very small percentage of them actually, and this is in the book, I can't remember the percentage right now, but a very small percentage actually touch the principal. So what most of them do, they spend up to the income, but even a good percentage of them, I think it's like 3 out of 7 or something retirees. So that's a weird percentage, I know, but 3 out of 7 will actually not even spend up to their income, which means they get paid, let's say $1,000 in dividends, let's say monthly, they spend 900 and they take the other 100 and they buy more. So even most of the retirees are still buying. So I know you ask like later in life, can I keep buying? Well, if once you're retired and you're starting to kick off income, you'll see that maybe your spending starts to decline in retirement. This has just been shown in the data, about 1% a year declines on average. So you might be buying more as well. So would I say just keep buying? Yes, but I would say if you're older, like you need to think about the risk, right? You should not be going in late 50s, 100% stock portfolio, unless you have like, I don't know, 3 years in cash or like there are ways to get to 100% stocks, but you have to make sure you have safety elsewhere so you can weather a storm or a 50% drawdown or an economic collapse or whatever it is. So I would think more about the risk profile.
Do you think that changes the thought process behind asset allocation and that traditional wisdom that you want to shift to more fixed income in retirement? Like, do you think that mentality might have to change as people live longer?
Yeah, I definitely think it means, more slightly higher equity allocation. I don't think it means you go from 60-40 to 90-10. I do think maybe you go from 60-40 to 65-35 or 70-30. I mean, once again, this is all within the context of your life, what you're spending. It all, like, at the end of the day, the only thing that matters is like, what I define risk as, my risk definition is like when you want to spend money and you can't, that's when risk shows up, right? Like none of this matters of all the stocks, that returns. If you have very low spending and you can cover your spending, if you have 100 years of spending in cash, it doesn't matter what you do with your portfolio, right? So at some point you have to think about, okay, what's the actual thing that matters? Like what's my spending, and then what's my portfolio, and how can it service that spending? That's where a lot of this comes in, especially for like retirees. And so if you're spending super low and you have a very large portfolio, it's not going to matter. As those two numbers get closer, that's where we have to be much more careful about the risks we take and thinking about asset allocation.
Okay, great stuff. Let's get this one from Jason. And Jason wants to know, is there a time frame to rebalance holdings the closer you get to retirement? How should we think about rebalancing ahead of retirement?
So, I mean, the thing about rebalancing, it's one of those things where I've looked at it every single way. I've tried, quarterly rebalancing, annual, semi-annual, annual, every 2 to 3 years. And they all, on average, they all basically come to the same place. Like there's no one rebalancing period that dominates any other, unfortunately. And yes, you'll probably find one, but it's probably mostly luck. You keep that, and if you test it in different periods, it doesn't win. So in terms of rebalancing, I try to do once a year. I think it's simple. It also makes sense for tax purposes, at least in the United States, like how taxes work. So I think once a year makes the most sense because it's just, it's something you got to do. And I said for tax purposes, it lines up. So in terms of rebalancing, if you're rebalancing annually and you're like, okay, how do I do this? What I guess is called a glide path to get as I'm getting to retirement, right? So let's say you're younger and you're like 80-20 stocks and bonds. And now it's been a few decades and maybe that 80-20, you've been rebalancing. So you've been keeping around there. You're like, okay, I need to start shifting to like 70-30. I need to start shifting down further, then yeah, you got to slowly just move that. And so it's gonna happen very slowly. Like I don't want you to be like, hey, I'm 80-20, and then all of a sudden you go to 60-40 because anything can happen. Like assuming 60-40 is right for you. But like I would say just think about the slow path. And so I would just slowly kind of move toward my thing. That's what a glide path is, and that's what most financial professionals tend to do with clients.
Okay, John has a question here for us, and John wants to know, is your book targeted to beginner, intermediate, or advanced investors? What would you say?
I would say beginner to intermediate. And don't get me wrong, there are some things in there that are advanced, and there's gonna be people in there that are like, hey, I don't understand this. Like my grandmother, who's in her 70s, she's like, I understood about 75% of the book. So 25% of the book is advanced, and she doesn't invest a lot or anything like that. So she got most of it, especially the first half of the book is about saving and personal finance more, and the last half's all the investing stuff. So in terms of where it's set for, I would say beginning. I would not even say beginning, maybe slightly above beginning, slightly before intermediate, and beyond, right? It's not too technical, too advanced, right? And I think for the joke I like to make is, if you think a 401k is a long race, like as they say in the United States, a 5K, right? So if you think a 401k is a very long race, then you shouldn't be reading the book. You probably need to get some other stepping stones first. But if you understand, in the United States, what a retirement system is, you understand what a 401k is, you understand this stuff, it's perfect for you. So I don't think, and I'll let Rob say what he needs to say about it, but I don't think it was that difficult to read. I think most investors would get it. So I would say a little more than beginner, but not necessarily advanced though.
Yeah, I would say generally speaking, it's a very accessible book. Like I said off the top, and I think that it wouldn't take too much for somebody to get themselves up to speed when reading it. I thought it did a fantastic job of kind of laying out the concepts quite clearly, as your blog does. We have one more question that we can squeeze in here from Hamsha, and they want to know, what do you read or listen to that helps you broaden your knowledge base on the market and make you a better investor?
So a lot of, I guess my knowledge of the market is just reading a lot of historical investment books, I love Bernstein. He's done so much with asset allocation. You're going to learn just so much from him. I'm trying to think of there's a lot of good personal finance books out there, but if you're just talking market history, there's going to be certain types of books that'll work really well for that. If you want, just feel free to DM, because I can just send you a list. It's easier than me trying to remember every single book and everything. So feel free to DM me on Twitter, Instagram, wherever you can find me. My website's there, my contacts there. Feel free to send me email, whatever works, and I'll happily send you hey, here's the list of all these different books. And it's not just investment books. I read a lot of stuff outside of investing, because understanding human behavior, understanding psychology, all those things matter because those impact markets as well. So it's a much broader view of the world, and it's fun too. It's also more fun to, I don't want to always be reading about investment stuff. And if you're new to it, when I was in my 20s, oh my God, I love reading investment stuff. Now it's much harder because I've read so much of it. I'm not saying I know everything. It's not that I know everything, but I've heard a lot of stuff already. So most of the stuff I'm going to be reading is not necessarily investment related, because I've read that material for so long.
All right, so there you go, Hamsha. So just reach out to Nick, and he can give you a long reading list. Maybe something in time for the holidays. You can stock up on some stuff, or go to your local library. Nick, thank you so much for answering all these questions from our audience. Great questions, everybody. There was fantastic stuff. We are unfortunately out of time. We're gonna have to leave it there. So thanks again for joining us, Nick. Really appreciate it. Filling us in on the just keep buying mantra, and kind of answering some of those questions that some folks might be too afraid to ask before, but now they've got the answer from you. So much appreciated. Any final thought you want to leave with our audience there?
No, I appreciate everyone's time. Thank you for spending your time to listen to this. Once again, if you have any questions or anything, feel free to DM me. As I said, Twitter, Instagram, whatever, LinkedIn, it doesn't really matter. Wherever you want to reach out to me, I'm there. I respond to every single DM. And it's me. I don't have a team or nothing. It's just me responding. So feel free to reach out if you have any questions or clarification. I can point you to resources, maybe other blog posts I've written, whatever, if it's going to help. So thank you.
Awesome. Appreciate that. And again, appreciate you taking the time. And thank you to the audience for joining us. We hope you learned a lot today, and we hope to see you again in a future episode. So like I mentioned before, check out some of our upcoming episodes. You can see them in the broadcast console there and the upcoming events. Click on a registration link if something catches your fancy, and we hope to see you there. You can also check out the resources section if you want to see a link to Nick's book, you want to see his blog of Dollars and Data, and you want to follow him on Twitter, X, whatever they're calling it these days. You can check it out there, as well as some of our past episodes. We really appreciate you tuning in. Thank you for taking the time, and we will see you all next time.
Have more questions? Check out the links to the right and in the description below.